Okay, let's unpack this. We are doing a deep dive into something that has, well, it's fundamentally defined the last 15 years of American finance, quantitative easing, QE. And the story here, it's not really one of temporary fixes. It's a history of escalating dependency.
It's a financial anomaly that really demands this kind of look. To get the scale, you just have to remember the baseline. Before the 2008 crisis, the Federal Reserve balance sheet was a pretty modest, manageable $900 billion.
900 billion.
And by its peak in April 2022, that number had surged to nearly $9 trillion.
900 billion to almost 9 trillion. That's a tenfold explosion in just over a decade. So our mission today is to treat this whole situation almost like a clinical case study. How did this supposed temporary emergency measure QE morph into what looks like permanent monetary maintenance? We're going to track the escalating doses of this financial drug and analyze the pretty brutal withdrawal symptoms that seem to prove the financial patient is, well, trapped.
That's exactly the frame. We're looking at a clear historical pattern here, a sequence of failed exits. Every single time the Fed tried to normalize the balance sheet, it triggered so much instability that they were forced to reverse course. And what you're left with is this massive balance sheet stabilizing at a level 7 times the old normal. The emergency drug is now the required daily dosage.
So let's start at the very beginning. Let's clarify the jargon. The biggest misconception about QE is that it's just money printing. People think of, helicopters dropping cash onto the street.
Right, and it's completely different. That distinction is critical to understanding why it tends to create asset inflation, not necessarily consumer price inflation. QE is fundamentally an asset swap. It is not about printing physical money or depositing cash into your checking account.
Okay, walk us through the mechanics of that swap, because this is where the money gets created, but it also stays confined.
So the Federal Reserve creates electronic liabilities on its own balance sheet. We call these bank reserves. And it creates them literally out of thin air. It then uses these new reserves to buy assets, mostly U.S. Treasuries and mortgage-backed securities, from big banks, the primary dealers. So the bank swaps a bond for a deposit of reserves at the Fed.
And the crucial part, the reason it doesn't immediately cause hyperinflation is that these reserves are functionally trapped, right?
Exactly. Reserves are electronic liabilities that can only be held by commercial banks. They don't circulate in the real economy. It's not the M2 money supply that you or I use for daily purchases. They add a ton of liquidity to the banking system, which is great for stabilizing markets, but it's a very indirect tool for stimulating real economic growth.
And we have proof this mechanism isn't a silver bullet for lending. We just have to look at the pioneer here, the Bank of Japan, the BOJ.
The BOJ is the perfect case study. They started their own QE way back in 2001. They doubled their bank reserves between 2001 and 2006. And if QE was supposed to cause this huge boom in real-world lending, well, it failed spectacularly. Bank lending in Japan actually declined by 25% and deflation just continued.
Which leads to that famous contradiction from former Fed Chair Ben Bernanke.
Yes, his little quip really summarizes the whole paradox. He said, the problem with QE is it works in practice, but it doesn't work in theory. It stabilized markets, no question. But it never really achieved that theoretical goal of creating broad, self-sustaining growth outside of Wall Street.
It certainly worked on the balance sheet, though, dramatically. So let's chart the addiction, dose by dose, starting from that emergency room moment in 2008. Again, baseline, 900 billion.
The first emergency dose was QE1, late 2008. The credit markets were frozen solid. This was a rapid $1.75 trillion injection. The goal was just market functioning. It was framed as a one-off, to avoid a second Great Depression.
But the patient didn't get well. The recovery stalled. And by 2010, the Fed felt like it had to step in again with QE2.
Correct. The goal shifted from just emergency repair to active stimulus. They wanted to fight off disinflation. QE2 added another $600 billion in long-term treasuries. The system was already showing it was dependent on that external liquidity.
But the real structural addiction, that was cemented with QE3. This is where the Fed basically said, we're not stopping until we see the results we want.
That's why I got the nickname QE Infinity. It was an open-ended commitment. Launched in 2012, the Fed just started buying $85 billion worth of assets every month. By the time it finally ended in 2014, the balance sheet was at $4.5 trillion. 5 times the pre-crisis baseline.
And then came the true overdose, 2020. The COVID-era QE program arrived, and it just dwarfed everything that came before it.
The speed and the scale were just shocking. Amid that market panic, the Fed started buying $75 billion a day.
Daily, not monthly.
Daily. When all was said and done, the total purchases hit $4.6 trillion. That is more liquidity than all the previous QE programs combined over the last 12 years.
$4.6 trillion in just 2 years.
Yep. That took the total balance sheet to its peak of $8.9 trillion in April 2022. If you want to see a chart of a patient building a tolerance, requiring a bigger and bigger dose just to get the same effect, that's the chart right there.
Okay, now for the most dramatic part of this story, the withdrawal symptoms. Because every single time the Fed has tried to quit this drug or even just reduce the dosage, the market has thrown a spectacular tantrum that forced them to reverse course. This is the Fed put in action.
This is the core repeating pattern. It shows how systemic the dependency has become. And the first major symptom was the taper tantrum in 2013. What's fascinating is that it wasn't even a real withdrawal.
Right. It was just the idea of a withdrawal.
Exactly. Fed Chair Bernanke just hinted. He merely suggested in May 2013 that the Fed might slow the pace of QE3 later that year. The market's reaction was instantaneous and violent. The 10-year Treasury yield, which was sitting around 1.94%, it spiked by over 100 basis points. So a full percentage point, it hit nearly 3%.
That is a massive move for the world's most critical financial benchmark. And the damage didn't just stay in the U.S.
No, capital just fled emerging markets. Those markets crashed. The volatility was so bad that the Fed had to delay the actual tapering for months. It was the first clear sign. The system couldn't handle being taken off its meds.
So they try again 5 years later with quantitative tightening, or QT. This brings us to symptom number 2, the Q4 2018 crash.
Right. By late 2018, QT was running at about $50 billion a month. Fed Chair Powell famously called the process autopilot. But the market showed the Fed wasn't flying alone. We saw a massive equity sell-off. The S&P 500 dropped 19.8%. It was the worst December for stocks since 1931.
And this sounds less like the market being irrational and more like an organism seizing up when its life support is threatened. I mean, didn't critics say they should have just stayed the course, just endured the pain?
That was the theoretical argument, for sure. But the financial and, frankly, the political pain was just too intense. It led directly to the Powell pivot. By January 2019, Powell completely reversed course, saying the Fed would be patient. The Fed put that guarantee that the central bank won't let asset prices fall too far was violently reaffirmed.
But the dependency wasn't just about stock prices. The third symptom showed the actual plumbing of the financial system was broken. The September 2019 repo crisis.
This was maybe the most frightening one because it was in the fundamental architecture of short-term funding. QT had accidentally drained too many reserves from the system. The repo market, which is how banks get cash overnight, is the foundation of liquidity. It normally sits around 2%.
And what happened that September?
Trust just evaporated. The price of overnight cash spiked from 2% to an astonishing 10% in the middle of the day. That signals a fracture. The Fed was forced to intervene immediately, injecting $75 billion daily to restore order.
And this was purely reactive. It proved they couldn't let the balance sheet shrink too far without the whole system just seizing up.
Absolutely. The Fed started buying Treasury bills again, expanding the balance sheet by another $400 billion. Powell insisted, he was very clear, this is not QE, but it was QE in effect. The body needed its fix, even if the doctor called it something else.
And finally, the most recent symptom, the one that showed QE had baked vulnerabilities directly into the banks themselves. The 2023 regional bank failures.
This is a delayed reaction to the drug. During the years of ultra-low rates, banks like Silicon Valley Bank had loaded up on long-term treasuries, which they bought when yields were near zero. When the Fed jacked up rates in 2022, the value of those bonds just crashed. For SVB alone, it created something like 15 to 21 billion in unrealized losses.
And as soon as that became public, depositors ran. SVB saw $42 billion withdrawn in a single day. It triggered its failure.
And the Fed's response. It confirmed the pattern again, intervention at all costs. They created the Bank Term Funding Program, the BTFP, which let banks borrow against those devalued bonds at their original par value, basically pretending the losses didn't exist. It was another rapid rescue, reaffirming that the central bank will always step in.
Okay, let's talk about the uncomfortable side effects, because this reliance on asset price inflation, the wealth effect, has had these profound social consequences.
It's the central criticism. The legendary investor Stanley Druckenmiller put it very bluntly. He said QE is the biggest redistribution of wealth from the middle class and the poor to the rich ever.
And the numbers, they really back that up.
They do. Before the crisis, the top 1% held about 24% of the nation's wealth. Today, that share is nearly 31%.
Hmm.
Meanwhile, the bottom 50% of the population hit a low of just 0.4% of total U.S. wealth in 2011. And that's because the top 10% of households own 90% of all stocks. So they are the direct, overwhelming beneficiaries of asset price inflation.
So if the wealth effect is the goal, QE is incredibly effective wealth stimulus. But it's structurally ineffective wage stimulus for the working class.
Precisely. And beyond that, there's the economic damage of zombification.
Mhm.
By keeping interest rates so low for so long, the Fed allowed unprofitable companies, these so-called zombie firms, to survive by just perpetually rolling over cheap debt.
And why is that a problem?
Because it gums up the whole system. These zombie firms have basically tripled, from about 4% to nearly 12% of listed firms. They tie up capital and labor that should be flowing to innovative, productive businesses. In the long run, it just drags down national productivity.
So if we want to see the potential endgame for the U.S., we really have to look across the Pacific at the original pioneer, the Bank of Japan.
Japan is the ultimate warning sign. They started QE 24 years ago. Their balance sheet is now a staggering 105% of their GDP. America's is about 22%. And crucially, the BOJ owns over half of all Japanese government bonds.
They are the market. And yet, for all that, they still suffered from deflation for over a decade.
It proves the policy can't guarantee growth, but it does guarantee dependency. When the BOJ tried their first rate hike in 17 years in 2024, it immediately created intense fiscal pressure on the government. Once a balance sheet gets that big, the government and the central bank are just permanently entangled.
Which brings us right back to the U.S. trap. You mentioned the $9 trillion peak, but it's the normalization failure that's really solidified this whole thing.
We have hit the permanent floor. As of December 2025, the Fed officially halted its quantitative tightening program. The balance sheet stabilized at roughly $6.5 trillion. That's nearly 7 times the pre-crisis level. And officials have been very explicit. Returning to $900 billion is not the goal. This new normal requires a $6 to $7 trillion balance sheet just to keep the banking system functioning.
So the temporary emergency measure is now a $6.5 trillion permanent feature of the system. And the biggest thing stopping any further exit is the government's own debt.
Absolutely. The fiscal tail is wagging the monetary dog. The U.S. government's interest costs are now over $880 billion a year. That's rivaling national defense spending. If the Fed were to truly exit and let rates normalize, the fiscal hit would be catastrophic.
And we can quantify that risk, can't we?
We can. Estimates from places like BlackRock suggest QE suppresses 10-year yields by anywhere from 2 to 4%. If that suppression ended, every 1% rise in rates adds roughly $300 billion to the government's annual interest costs. The Fed cannot tighten too much without pushing the Treasury towards a crisis.
They're trapped by the very policies they use to save the system.
Mohamed El-Erian summarized it perfectly. He said central banks became the only game in town, and now they find their destiny is no longer entirely theirs to control. They're constrained by the sheer weight of the debt they helped create.
So let's synthesize this for you. Quantitative easing went from an emergency fix to a permanent framework. The entire history since 2008 is just one long series of failed attempts to withdraw the drug. That $6.5 trillion balance sheet. It's here to stay.
The system appears stable only because it's constantly supported by this massive central bank presence. The addiction is complete. That $9 trillion peak wasn't some outlier. It was just the dose required to fight that specific crisis.
And that leads us to the final and I think chilling question that we'll leave you with today. What happens in the next recession if every crisis requires a bigger dose of QE than the last, and we saw the leap from a 4.5 trillion peak to an 8.9 trillion peak? What volume will be needed to fight the next one?
The question really is, how long can these temporary policies continue to grow indefinitely? The central bank is no longer just a manager of short-term rates. It is the permanent architect of the market. And you have to consider the ultimate test. Can a central bank that is perpetually forced to expand its balance sheet maintain its primary function as the stable store of value the entire global economy relies on? That is the structural trap America now has to face.